Hey guys, and welcome to Money Talks News, the podcast. We're going to talk to you today about whether Donald Trump is going to affect your retirement account in 2025. I'm your host, Stacey Johnson. With me is my producer and my friend, Aaron Freeman. Hey, Aaron.
Hey, Stacey. It's good to be here with you again.
Always a pleasure, my friend. So what are we going to talk about today? Here's the thing. I've been doing some studying on this before we went on the air, and I was thinking, this reminds me a lot of a comedy routine by John Mulaney. We've seen John Mulaney together.
Yes, we have.
Okay,
I think
anyway,
I know the comedy routine
guy.
You're talking about. Yeah.
It's called The Horse in the Hospital.
This guy being the president, it's like there's a horse loose in a hospital.
And the reason I mention this, it's a very funny thing. If you guys haven't heard it, you can see it on YouTube, but just look up Horse and Hospital. And what it's about, he recorded this when Donald Trump first became president in 2016. And what it's about is like, there's a horse in the hospital. Who knows what the horse is going to do? The horse might do anything. We don't know because there's never been a horse in the hospital before.
But I have no idea what's going to happen next. And neither do any of you.
Because, but the truth is, here we are again. Okay, the horse is back in the hospital, and the horse is saying all kinds of weird things.
Man, is he ever.
Yeah, just this week, he's talked about annexing Greenland.
But nobody knows if they even have any right, title, or interest. The people are going to probably vote for independence or to come into the United States.
Invading Panama.
It's being operated by China. And we gave the Panama Canal to Panama. We didn't give it to China.
Changing the name of the Gulf of Mexico. And, here's the thing, and this is why I bring this up. It's not that I hate Donald Trump. I'm ambivalent on who the president is. But what's important is I don't know what the hell's going to happen.
Right.
And the stock market doesn't know what the hell's going to happen either.
Right. And he's elected. Why is he saying these things?
Yeah. And this is how he got elected, because he says outrageous things. But the stock market doesn't want outrageous things. It wants to know what the path forward is. And what these guys are doing is they're rolling the dice. Okay. And when I say that, what I mean is they're going to try to lower taxes and make up for it with tariffs. And this is what the horse is saying now. Okay, I don't know what's going to actually happen, but but I think that's the idea. Cut government regulation, cut taxes, make up for the deficit that would result by increasing tariffs. Now, will this work?
Well, past said sort of no.
I don't know. know.
Okay, so when his first term, right? He went in and he put in a bunch of tariffs right off the bat.
Yes,
right, and he inherited a good economy when he was in office, right? And so between doing that and all these other things, he actually increased the deficit. And the deficit actually was 100% of the economy.
Yeah, the deficit was, yes, but remember COVID had a lot to do with that too.
Well, yes, and COVID had a lot to do with it. I was going to say that too. But so explain to me how he's going to do better in the second term. Well, because a lot of people are going to say is like, well, he didn't get to finish his second term the first time to really prove that his policies are going to work.
Well, we'll see what happens. But the point I'm really making here, Aaron, I was a stockbroker in 1981. Okay, I've been doing this for 40 years, and anyone who says this time it's different is generally wrong, because history does repeat itself, or at least it rhymes. But here, this is really weird because I really don't know which way to turn. There are some things here that make the stock market look very attractive in 2025. For example, less regulation means more profits. Lower taxes obviously mean more profits for companies, and that can translate into higher stock prices. However, if these tariffs do become inflationary, and if the deportation of millions of workers starts to affect the labor market, then that's negative, and I'm just not sure whether, I'm assuming that a lot of this stuff is a bluff. I don't think we're going to invade Greenland. I don't think we're going to deport 10 million people. And I hesitate to think that there's going to be an across-the-board tariff of 60% on every single thing coming from China. I don't think those things are really going to happen. But they might. The horse is in the hospital. I don't know what he's going to do. And of course, obviously, a lot of this stuff takes congressional approval too. And I'm not sure whether that would be forthcoming or not.
Well, Not always. His tariffs, not all of his tariff stuff takes congressional stuff. I mean, there's a lot of acts that supposedly he can pull from the 70s and the 60s that
You mean for tariffs?
The language is very kind of loose. That
Section 301, he could declare an emergency and say that he's going to raise tariffs, and I think that's what he will do. And I think even if it did go before Congress, depending on how it was introduced, because obviously their lead is very narrow in both the House and the Senate, depending on if it's in a reconciliation or something like that, where it only takes 51 votes, he could get the approval of the Congress anyway. But here's an example. Okay, the other day, the Federal Reserve lowered interest rates by 1/4 point. This was widely expected, and guess what happened in the meantime? Or right after that. Now, you would expect rates would have dropped, right? I mean, the Fed can only control very short-term rates, okay, the Fed funds rate. And so but generally when they lower that rate, rates across the economy go down. The 10-year Treasury goes down. The 5-year Treasury goes down, which means the 10-year Treasury especially means that mortgage rates are going to go down. Car loan rates are going to go down. And so that's why that's what the Fed is doing. They're lowering rates to stimulate the economy. So it makes it easier for people to borrow. Now, here's what's weird, though, that doesn't typically happen. Interest rates didn't go down. The rates that they had oversight on went down because they can make that happen. But the 5-year interest rates are higher now than they were last spring. And 10-year rates are too. And now, why is that? You know why? Because
no, I don't.
The horse in the hospital. Let me read you something. Okay. This is from The Hill. I've got a few quotes to read today. Fed officials expect to move more slowly on future interest rate cuts, according to December meeting minutes released yesterday, Wednesday. As reasons for this judgment, participants cited, now listen to this. As reasons for this judgment, participants cited recent stronger than expected readings on inflation and the likely effects of potential changes in trade and immigration policy. Okay, so what's happening is the Fed was all ready to cut rates more. And then these policy proposals came up. And so now they're going like, well, wait a minute. We don't know if these are going to be inflationary or not. Therefore, we're not going to lower rates until we have a better idea of what the hell's going on. Now, that's an example of something you don't see very often. You don't typically see the Fed lowering rates and the market responding with higher rates, right? And the reason, part of the reason for that is the uncertainty of what the heck is going to happen.
Right.
You mentioned,
I guess is that why also we've seen the stock market kind of like doing this because they're trying to adjust their positions, trying to figure out, well, we have no idea if this is going to be good or bad.
Yes, because now we all know that higher rates are not good for stocks, right? Because if it costs businesses more to borrow, then they make less money, blah, 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 flows to the bottom line. So look at what we've got here. We've got a situation where regulations are going down, good for business. Taxes going down, great for business. But what if interest rates go up because of the tariffs cause inflation?
Right.
So that's why I'm kind of like a deer in the headlights. I'm not sure what to do.
Right.
And the other, go ahead.
No, I was going to say, I mean, you're touching on tariffs, and in Trump's mind, what I wrote down here, he says, so this is what he says. This is his quote. The higher the tariffs, the more likely that it is the companies will come to the United States and build factories in the United States, and so they don't have to pay tariffs. So he says he thinks that by bringing these companies, by creating higher tariffs in these other foreign entities, either American companies or companies are going to put their manufacturing here in the United States to try to avoid these tariffs.
Yes,
which is. Okay, so you can explain that one.
It's complicated.
It doesn't work.
Yeah, well, the thing is that kind of thing that's the purpose of tariffs, really, is to protect domestic manufacturers. But if you're a domestic manufacturer of cars and all the parts that you're using come from China, then those cars are going to get more expensive, even though you're here. So, and another thing too, imagine this. You and I are competing businesses. We both sell cars. You're in the United States. I'm in China. Okay, now I sell my car for $8,000. You sell yours for $10,000,
right? Because
my labor's cheaper. Okay, exactly. Now the president comes along and he says, "Okay, I'm going to put a 50% tariff on all of Stacy's cars. So now my cars cost $12,000. Your cars still only cost $10,000.
So now my American cars seem cheaper.
Right, your American cars are cheaper.
Right.
But what are you going to do though when you find out that the close your competitor is now dust? I mean, I'm charging $12,000 for something you're selling for 10. Would you think you might raise your price to 11?
Well, of course,
you've got no competition.
I've got no competition, so I'm going to raise it up so that my stock portfolio looks better.
Right. Well, I mean, you're going to raise your price. You're going to make more money, and so that's inflationary. So try to keep. In other words, this is a complex topic with lots of different facets to it, and so whether raising tariffs is a good idea or not. Historically, it has not been. I was looking at a research report last night from J.P. Morgan Private Banking, and they said, well, here's one thing you might remember. He raised the prices for aluminum or something like that. Anyway, appliances became more expensive. They went up by like 18%.
Which is another ability that the president has within one of those acts is raising tariffs on metals.
Yes.
But his other weird belief, though, I think it's more of like a negotiating tactic is why he's saying this stuff. Because one of the things he said is that he believes that putting tariff pressure on countries will bring them to the table. Because he said this thing that he thinks he can thwart manufacturing of fentanyl in Mexico by putting tariff pressure on Mexico, saying you will, get rid of this fentanyl
and that may
in
work.
Your country. And then, of course, the president of Mexico, replies back with, "Well, maybe if America didn't have a supply demand of wanting fentanyl, then we wouldn't have this problem in the first place."
Well, and that's absolutely true. I mean that's absolutely true. But what you said too, Aaron, is pertinent because if you're Mexico. And I'm the United States. And I go, you know what, Aaron? I'm going to start charging you 25% tariffs unless you stamp out those the fentanyl factories. And then you're going to go, don't tell me what you're going to do. I mean, I'll put tariffs on you, blah, blah, blah. But you know what you will do? You'll probably get off the phone with me and call somebody up and say, we need to raise some fentanyl factories. And so, as you said, this is something he may be using as a bluff. And again, the rest of the world looks at him like I said in the beginning of this podcast. This is a horse in the hospital. I mean, he may raise your tariffs 25%. He may invade your country, and we don't know what he's going to do. And this is a valuable bargaining chip. Acting crazy.
Well, I think he acting crazy is the way he's getting people to the table to try to negotiate something that he's looking for in some other facet. What do you think about this? Okay, so let's say he does all these tariff things, and it blows up the world economy. So, for example, like South America and stuff like that, they've actually looked to China for better trade deals. And so have other countries. So if it's tough to do trade deals with America because of all this stuff, wouldn't it kind of force other countries, even our European allies, to go, okay, fine, we'll find better deals elsewhere?
It's possible that that's true. And they certainly, one would assume that they will have retaliatory tariffs of their own. And I think there's some history of that. When he made Harley Davidsons more expensive in Europe, they came back and said, well, we're going to make liquor more expensive. And so, there will be retaliatory tariffs. And certainly in the case of China, they could also refuse to sell the components, not the components, but the minerals that we need to make batteries. I mean, there's a lot of shit that can happen here. Pardon my French. Right. And I think this is why you see interest rates going up when they should be going down. And until this stuff gets ironed out, until we see whether this is a bluff or the real thing, we're probably going to have higher rates because tariffs and exporting millions of people or deporting, millions of people is inflationary, period. So until we find out whether this is actually going to occur, interest rates, you mentioned when we were talking yesterday, I think, about bond vigilantes.
Yeah.
So these are people who are this term, by the way, bond vigilante was coined by Ed Yardeni, who I know. I mean, I don't know. He's not a friend of mine, but I met him because I worked for E.F. Hutton in 1981, and he was the chief economist for E.F. Hutton. Anyway.
Yeah. He coined that in a book or something.
I don't actually know. But anyway, a bond vigilante. So what's happening is the bond vigilante they're selling bonds, which make the rates on bonds go up. Okay, when
bond traders in general, the guys that buy the government, bonds. That are,
and you're picturing vigilantes as being a bunch of guys on horses hunting down, the rustlers, whatever. But what these guys are really doing is they're saying, I'm uncertain of the future. I'm uncertain that you're going to be able to keep interest rates low because of the policies that you're enacting. And so they're selling bonds because bonds are risky. In other words, if interest rates go up, bond values go down. And if you've got $10 billion in government bonds, and you're a trader, then you probably don't want them to go down in value. So you're selling them, and that makes interest rates go up. So so the market is telling you something.
Right.
And it's really important. In fact, I think I
don't know if you're really explaining that to people. Like, they're called bond vigilantes because it technically seems like they actually have power over the government. They're scaring the government into saying what I'm doing in my policy. So I don't know if you can explain that better. I was trying to understand it myself. I was reading about it this morning. Like, I'm trying to wrap my head around it.
No, you said it perfectly.
Let's say you're a bond, you're a bond trader, and you've got whatever $10 billion in 10-year treasuries, and you bought them at, like, I'm trying to understand this. So you explain to me if I'm right. You bought them at, like, let's see, 3%.
Okay, they were paying 3%. Okay,
they're paying 3%, and you bought them for 10 years. Now, all of a sudden, policies come in. You go, whoa, I don't like these policies, because the policies are going to bring the yield up to 5%.
Yes, that's what you're afraid of, right? And if you think that's going to happen, you're going to sell your bonds.
So you're going to sell your bonds at 3%, which forces the government to buy those back, because those are government.
Well, there's just the open market.
Is that what the deal is?
Or? Here's what's confusing about the word vigilante. It appears as if these guys are manipulating the government. What they're actually doing, Aaron, is, okay, let's say, for example, you and I or everybody in the United States is freaked out about the stock market because we think there's a horse in the hospital. Okay, so we all sell our stocks. Now, we didn't have any coordinated effort to make the government do something, but if we all sell our stocks and the stock market drops, 5,000 points, or interest rates go to 10% on government bonds, the government pays attention to that, and they're going to go, oh my God, what the hell did we do? We did something wrong to freak these people out, and then they're going to do something to keep us from being freaked out. That's what it means. It's not like they're directly influencing the government. They're just, but when interest rates go higher, like what the Fed just did, they lowered rates are up, and so that's getting their attention. So they could,
but does that cause the government deficit to go up? Or does it cause the government to,
well, sure, because the government's now paying, they have to pay me more interest.
Right, because they're selling at a lower rate and they're rebuying the bonds at the higher rate. So that causes.
Yeah, well, I mean, if the interest rates are now 5 and the government issues debt, which they do every week, then, that's costing them a hell of a lot more money than it did when rates were 3. And so they're paying attention to that.
Right.
And that's what a bond vigilante really is. I wanted to read
So now, to bring that around, so now Trump is kind of, he's a guy who wants to make money himself, and he hasn't hidden the fact that he hasn't done anything these other presidents have done. He's never put, his stuff in a blind trust. He's never, he's pretty much said, I'm here to make money for myself and for the rest of the world, the rest of the country. So with that, I mean, it seems like there's some pricing pressures in there that would keep him from wanting to do too many radical things, because it would hurt his own portfolio. So, I mean, are we looking at him trying to leave a legacy in these next 4 years of something crazy, or is he trying to just make money, which he wouldn't do anything crazy?
I don't know. I mean, the horse isn't trying to cause damage in the hospital either, but but the horse maybe not know what the hell it's doing. And I'm going to back up. I've said this many, this horse in the hospital thing. I'm not calling Donald Trump a horse. I'm not saying he's a bad guy. I'm just saying that some of the things he's doing are very unusual. And I'm not sure what his motives are, or whether he'll be able to follow through on them, or whether he even wants to follow through them. I don't know. Just like we don't know what happens when there's a horse in the hospital. Let me read you something that came from JP Morgan Private Bank again. And this is a good paragraph. And I want everybody listening to this podcast to just hear this one thing, because now we need to talk about what's going to happen this year, what we're doing with our money, and we're going to. And let me lead into that by reading you this. Ultimately, the 10-year Treasury will be the best barometer of the new administration. If the supply side benefits from deregulation and tax cuts, if that overpowers the inflationary impacts of tariffs, a shrinking labor supply, and large budget deficits, the 10-year should remain in the 4.5% to 5% range. But if the 10-year rises meaningfully above 5% and stays there, something will have gone very wrong. So here's something for our listeners to latch on to. You can go to CNBC or any number of other websites. You can see where the 10-year is. It's gone up.
It was 4.7, I thought I saw.
Yeah, 4.687, so 4.7. Yeah. So that's something you guys can keep an eye on. And obviously, this is one bank's opinion. This is not gospel, but it's something that's interesting. Because if those interest rates are going up, that's going to hurt stocks. And stocks right now are priced to perfection. I mean, the stock market is super overvalued.
Yeah. Well, we got like the what is it called? The big 5 or the big 7? What are they, like 40? Was it 40 times earnings? PE earnings?
Well, they're not. I don't know. I don't think the whole group is 40 times earnings, but they're high. They're historically high. And look at what Warren Buffett has done. He's taken money out of the market, a lot of money out of the market, because, I mean, so getting into what I'm doing personally with my money is I've got millions of dollars, a couple of $1 million in the stock market. I'm not taking it out. However, I'm also not buying. I'm not going to buy when things are this uncertain and when things are this overvalued. I'm just not.
Yeah.
I mean, you in my opinion, the way I made the most money in the stock market is I bought when everybody else was selling. In other words, I bought in 2009. I'm not a guy who day trades.
Super smart.
Yeah. Well, it's just, it's not smart. It's experience.
Okay. Well, for example, Trump's first term, there's a bunch of different numbers on this. Some people say 16, some say 14, but the gist is that the S&P 500 went up 14% during his first 4 years.
Yes.
Even with COVID and everything else. Now, we can put a chart in the podcast or somewhere there, but if you look at every chart for every president, there is basically a growth in the S&P 500.
Yeah. Well, the market
except
goes
for
up more
times
often
when
than it goes down.
for times when there's like something cataclysmic, like
Yes.
World War II or the Gulf War or COVID or the housing crisis.
I think I don't look at things
but you
like
sent
that.
me. I'm sorry to cut you off. But you sent me a good New York Times article, showing why people lost money when they got out, the market during times of. So you're kind of alluding to that when you're saying I'm not out of the market.
Yes.
Can you explain to everybody, what that New York Times article was saying as far as like, you could lose by trying to time the market.
It's just as simple. I had Apple. I own thousands of shares of Apple. It made me $1 million, but I don't have a lot of it anymore. But when the last recession came, 2009, whatever the Great Recession, I sold some Apple prior to it going down, and it was smart. I don't remember what the prices were now, but I sold it, and I was right. It went down in value, but guess what? I didn't buy back in, because when you sell something, you got another decision to make now. Are you going to sit on, and you're often going to find yourself sitting on the sidelines, watching the stock market go back up. And as a matter of fact, when during the pandemic, I bought NVIDIA. I put $10,000 in NVIDIA. I was going to put in 20, but I was waiting for it to come down more. Guess what? It didn't. Now I made $250,000 on that, $10,000, but could have been $500,000. But the point is this: when your point first, the market tends to go up over time. It always has, because the American economy expands. To hell with the president. That's just what happens. The president can help, the president can hurt, but the economy expands and businesses become more valuable and the stock market goes up. And so selling and trying to time the market is often a fool's game. The extent of timing I'm doing now is there are stocks I want to buy right now. I'm choosing not to do that because they're overvalued and because I don't know what the horse is going to do in the hospital. And that's really all it comes down to. So if I'm a person listening to this podcast who's retired or going to be retired soon, and it really matters where this stuff goes up and down, I would be cautious about buying more. But this is why, you remember Miranda, our podcast host for many years, she would always say, dollar cost averaging, baby. You put it in now. And then if I'm not buying now, but market keeps going up, at least I put a little in. And if the market goes down, it's going to be cheaper and I can buy it then. So averaging in is still fine. But I would not take a lump sum of cash and buy the stock market right here.
Would you, so let's talk about people that could be retiring within these next 4 years. What's your suggestion to them?
I hope I'm one of those people. I am underweight in stocks relative to my net worth. So I would be, if you're going to need this money in a year, I would take some money off the table right now. I certainly would. You've seen how volatile the market is. It goes up 400 points one day and goes down 400 the next. And the reason for that is because of all the uncertainty that's out there. If I know I'm going to need money in a year, especially if I've got nice profits, and you should, if you're invested in any of the Mag 7 or whatever they're called, take some money off the table. Make yourself comfortable. The amount of money you should have in the market is very, very easy to determine. It's not a percentage. It's the amount that makes you not worry. Like I said, I've got significant money in the stock market, but I've got significant money not in the stock market. So I ain't worried if the stock market falls 10 or 15%. I'm not happy. I'd rather be richer than poorer, but it's not going to keep me up at night. If the amount of money that you're going to lose is going to have you staring at the ceiling, then you've got too much money in the market. And that's true, period, no matter what the market's doing. Does that make sense?
That makes sense. Makes sense. Now, what about guys like me? I'm in my 50s, and obviously we got some time, before retirement. And I'm dealing with a lot of uncertainty here. We've got, not only we don't know what Trump's going to do in the global market, but we also have pressures of AI, which we have no idea what that disruption in the workforce is going to be like. Some people say it's going to be great, and it's going to be an economic boom like we've never seen, like a renaissance. And then other people are saying, well, it's going to be a transition period that's going to be rough.
I think that's true. I'd say
with that, I mean, like you're saying, okay, well, the market's high. Should we say, okay, well, are we pulling money out and investing in other little companies that are not like the 40?
I would be careful about doing that. You know what you might want to do, Aaron? You might want to get an AI ETF, so you're not putting all your money on one, which in my opinion would be NVIDIA, but you're not putting all your eggs in one basket. But and I don't think there's anything wrong buying NVIDIA either, but especially on pullbacks. But buying an ETF and then average in, because I'll tell you what, I am positive. I could be wrong. I've certainly been wrong many times before, but I am positive AI is going to change the world. I am also positive that this is like investing in the internet. I mean, I miss the internet. I mean, I didn't because I owned Apple and I owned Microsoft, but point is, it was way bigger than I thought it was going to be. Smartphones, way bigger than I thought they were going to be. I bought Apple because of what was the little music player they had, Aaron?
Oh, the little iPod.
iPod. I bought that because of iPods. And it just so happened they invented iPhones right after that, and I got lucky. But the point is, this is going to be a game changer, folks. And you should have some money in AI. And the safest way to do that is an AI ETF. And you can easily look up, which I do stuff like this all the time. Just go to AI or go to Google and say, what's the best AI ETF? Just like that. And then do a little reading and buy some of this, because this stuff is going to change the world. And maybe not in totally positive ways either. Because a lot of people, I'm doing stories now with AI that cost me less than a cent. And I'm paying people $500 to write stories for this website. So, this is a game changer. It's a game changer for me as a website owner. It's also a game changer for people who are charging me $500 to write a story. Now, let me hasten to add that the AI stories are not as good as the stories that are sourced by real humans and went to college and are journalists. But how far away is that future when it will be? So if I'm that writer or that video producer like you, Aaron, I might be concerned about my future.
Yeah. It's tough. I read a lot about this stuff, and there's two sides of the coin to this thing. And there's a lot of people that are positive, who are actually people that are pushing it, and there's a lot of people that are in the game. They're actually coders. They're actually the ones doing this, and they're saying, I don't see anything good for society out of this thing.
I can't imagine that a lot of people aren't going to lose their jobs.
Right, and that's why they're saying, like, everybody pretty much in AI world, from physicists to mathematicians to coders, are all saying this is going down. If anybody ever saw Star Trek, that Next Generation show where, pretty much everything is given to you, where, technology is so free and so cheap that you can pretty much make things out of thin air. They're saying this is where it's going.
Yeah.
Eventually.
I think it will.
There's a utopia ahead. But their problem is that they're saying there's going to be this middle part, which is going to be a little bit rough.
Yeah, and this genie's out of the bottle. I mean, it's going to happen.
But I agree with you in saying, like, if you invest in it and you're part of the investor group, it might help you in what do you call it, hedging through the turmoil.
I'm never 100% certain about any investment, but I'm pretty sure about this one. Yeah. And that doesn't mean I'm inviting people to sue me if it goes south, but I think AI is looking pretty good. And actually, Aaron, that should be the topic of our next podcast. We should talk about AI, the pluses, the minuses, how to invest in it. Let's do that on our next podcast.
Yeah, we can do that.
And I want to remind everyone to make sure, if you're not a member of Money Talks News, go to moneytalksnews.com, sign up for our free newsletter. You can follow us on YouTube, which presumably you're doing if you're watching this. And we're on Instagram, and we're on, what else here? We're everywhere you can be. So subscribe, listen, and we will be back in. Any closing thoughts, Aaron? Are you good?
No, I'm like you. I'm still like wondering what's going to happen. I mean, I'm wearily waiting January 20th to see what this guy does right off the bat.
I think we can assume whatever it is, it's going to be newsworthy.
Yeah.
We're going to have some headlines.
We're going to be talking about this all year long.
So folks, keep your eye on the 10-year. Make sure if it started approaching 5%, get a little nervous. The stock market will probably start going down when that happens. And keep an eye on that horse in the hospital. You guys have a great day, and we will talk to you soon. Later, Aaron.
Bye.